The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box. I'm Karen Cho with Sylvia Amaro. These are your headlines today. President Trump says the economy needs time to transition as he vows to continue a radical reshaping of trade policy, refusing to rule out a recession.
There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing.
Mark Carney wins the race to become Canada's next Prime Minister in a landslide victory as tariff tensions escalate with its closest neighbour.
He's attacking Canadian families, workers and businesses, and we cannot let him and we won't.
German coalition talks will formally begin after the CDU and SPD agree on a series of initial policies, including cheaper energy prices and tax reforms in a bid to boost the country's ailing economy.
We will create sensible investment incentives. We will have to discuss the details in the coalition talks, and we will start with a corporate tax reform.
And the negotiators head for Saudi Arabia as the US and Ukraine look to reset after last month's Oval Office bust-up, with President Donald Trump calling for quick progress.
Good morning. The market's now tossing the word recession around, and that is a serious word over the years as we've been talking about whether there'll be some sort of economic contraction. And how much of this do we take stock in the fact that Trump is talking about whether he is worried about the prospect of recession, whether there's a necessary evil here to get tariffs done, but then pushback from the administration too over the weekend, suggesting that the US is not on course for a recession. So what we've got a market that is spooked, no doubt about it, when it comes to the tariffs. We saw that last week. The question is whether tariff threat and some of the no confidence that's coming through the markets equals a recession.
I actually had an interesting conversation on Friday. I had the chance to speak to one Fed official, and I actually asked Adriana Kogla where she has her mind really around these conversations around the potential economic recession. Is there a shift in the Federal Reserve about focusing more on the economic or the lack of economic growth rather than inflation? And she still said, the economy is still very strong and we're still laser focused on those inflation numbers.
Yeah, we still saw it in the payrolls number, still strong enough. KBE, though, the banking index last week was down 6% if you're looking for some sort of an economic marker through the stock market. Our US Commerce Secretary Howard Lutnick says steel and aluminium tariffs will take effect on Wednesday as planned. Administration officials say the policy aims to stop countries, including China and Russia, avoiding existing levies. US steelmakers urge Trump not to delay the measures after the president's decision to exempt a significant number of goods from tariffs against Canada and Mexico in the past week. Speaking to NBC's Meet the Press, Lutnick says he's confident that President Trump's tariff policies will support Americans.
Donald Trump is going to try to balance the budget of the United States of America. And when you balance the budget of the United States of America, you drive interest rates down 150 basis points, 1.5%. You're going to have mortgages come smashing down. The cost of your home will come smashing down. We're going to drill and drive down the price of energy. That's coming down. So these two massive moves are going to happen. And you know who's going to pay for that? Tariffs and outside countries who just leech off of us, lean on us, earn money off of us. They've got to start to pay. President Trump wants the American people to start to understand the External Revenue Service should start to pay. Yes, some products that are made foreign might be more expensive, but American products will get cheaper. And that's the point. Buy American, made by great Americans.
We're going to unpick this more in this show, of course, about who does actually pay for tariffs. But in the meantime, President Trump did not rule out a recession amid escalating trade tensions, telling Fox News his plan to boost the economy would take time.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
Treasury Secretary Scott Bessent also said he expects a period of transition as the Trump administration enacts its policies, but told CNBC he's confident interest rates will fall.
We're trying to get rates down, and could we be seeing that this economy that we inherited starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period.
China's Commerce Ministry has announced tariffs against a number of Canadian food and agricultural products in retaliation for Ottawa's tariffs on Chinese EVs and metals. Canada's Trade Minister described the levies as unjustified.
Let me run you through some of the market activity on Friday so we get you up to speed what's likely to happen as well later today. Starting with the three U.S. major indices, we actually saw a positive session on Friday despite these growing conversations around whether we're going to see a recession in the U.S. economy. Just to give you a bit of context, we saw the Dow posting gains of about 0.5%. But it is the week-to-date performance that I will just highlight for a moment. The Dow actually dropped 2.37% on the week. So there is considerable amounts of pressure on U.S. equities. Thinking about the bond market, let me take you to treasuries too. Here, though, we actually saw bond yields rising on a Friday. There has been a bit of a change in trajectory on Friday. At the end of the day, we saw yields rising, reversing the earlier declines. And here, the main market narrative were the comments from Jerome Powell, the Fed chair, actually suggesting that the U.S. economy is still very strong. And he made the comment that they can wait, really, to see what is the impact of some of the economic policies of the White House on the market, on the economy, to understand how then the Fed can react to those too. For the time being, he said there's no rush in announcing a rate cut. Thinking about the FX market, let me show you how what have been some of the moves in the currency space. All in all, though, it's important to keep in mind that markets here, investors here are tracking all comments around a potential trade war, whether that's with the EU or the United States. One pair to think about is the euro against the US dollar. The euro actually rose last week against the US dollar. At this stage, we are just a little bit higher for the euro against the greenback. I want to take you to commodities too. Let me give you an idea of what's happening in terms of WTI prices. We are a little bit lower at this stage as well, also for Brent. Thinking about some of the moves, however, in the oil market, we were down almost 4% for WTI prices last week. Brent also down almost similar levels, almost 4% for the week too. All in all, though, here investors continue to monitor what are these conversations around economic growth, the lack of it too. And thinking about the Asian session, let me show you how that has been moving too so far today. Thinking about the Nikkei 225, we are actually up 0.5%. A little bit of pressure, however, for Chinese equities. The Hang Seng is down almost 2% at this stage. The Shanghai Composite down 0.5%. We know that today we are having the official retaliation from China in terms of trade tariffs on the United States. And thinking about Europe, let me show you how we're likely to open in a couple of hours' time. At this stage, the opening call suggests a positive start to the trading day for European equities. This despite ending Friday on a lower note. However, if you think about the year-to-date performance for European equities, as we've discussed, Karen, it has been quite strong.
Yeah, looking certainly very upbeat this morning.
Yeah.
House Republicans have released a stopgap bill to avoid a government shutdown on Friday. The continuing resolution would extend overall funding at current levels, with a slight boost to defence and cuts to non-defence programs. President Trump threw his support behind the bill, calling on Republicans to remain united. One Republican House member has expressed public opposition to the plan, meaning Speaker Johnson will need the support of all other GOP members to overcome Democratic opposition in the chamber. If the bill passes in the House, it will still need the support of 60 senators, requiring at least 7 Democratic votes.
And in the latest data, U.S. non-farm payrolls grew by 151,000 in the month of Feb, stronger than January, but below economists' expectations. The federal government employment fell by 10,000 in the period, but many layoffs led by Elon Musk's Department of Government Efficiency took place after the survey's reporting period and won't be included until March. Fed Chair Jerome Powell says the data shows the central bank should not rush to ease rates.
Despite elevated levels of uncertainty, the U.S. economy continues to be in a good place. The labor market is solid, and inflation has moved closer to our 2% longer-run goal. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
And speaking to me at the Bank of Portugal event on Friday, Fed Governor Adriana Kugler said that the central bank needs to account for the risk of persistent inflation.
There is reason to believe, potentially, that there could be price increases and more persistent inflation, but potentially also price increases because of some of the policies that maybe are being considered and some that have already been put into place. And that could also have an impact on economic activity. Mm-hmm. So the question is, which one is going to happen first?
Yeah.
Right? Is it the effect on prices or is it the effect on quantities? And usually we know that the effect on prices is faster and happens more quickly than the effect on quantities. So I don't think that's what they're seeing, but I think first things first, we need to probably take account of some of these persistence that I mentioned because of different categories of prices, because of inflation expectations, and potentially because some of the new policies that are ahead of us.
And let's get to Bryn Jones, Head of Fixed Income Research at Rathbones. Bryn, there's so much to talk to you about this morning. Scott Bessent suggesting earlier that they're trying to bring rates down stateside. But at what cost? Are we talking about a recession here? Because over the weekend, big debate from President Trump about this transition period, not ruling out a recession, had a pushback from the Commerce Secretary saying that's not where we're going. But if you look at some of the official data, what we're witnessing from the Atlanta Fed suggesting at least in the first quarter, in fact, we could be looking at a contraction. So are we heading towards a recession thanks to all of the tariff uncertainty?
Rarely do rates go up through history and that you don't get a recession. So, rates started rising in 2022. If you look back through history, we'd have had 4 recessions by now. And you're kind of moving into the back end of when you would expect recessions to occur. So just from a historic perspective, you would expect rates going up would potentially cause the recession. Trump's a big fan of golf, right? And, it's a bit like a bad golf swing. If you go and see your golf pro, you tend to go backwards before you get better. So I guess this transition period is kind of, maybe like a bad golf swing where they've said that they're going to change some things. But look, those that play golf also know that you can change your swing and that actually it takes a very, very, very long time before you play better golf again. And so I do think that, if you look at through some of the data, there's evidence. Just on Friday, if you look at the average hours worked, the last time we were at these low levels was COVID, and the time before was GFC. Now, while structurally the economies are different since post-COVID in the way that people work, there is sort of kind of like little canaries that indicate to me that we are heading in that direction. So as a result of that, we've maintained, on the fixed income side, a certain element of duration in our portfolios to protect us and benefit from falling yields.
It's good storytelling there that you've just given us around golf, because we all know it can be very frustrating in terms of executing well. And what we're seeing, very frustrating tariffs now, I think, for a lot of countries dealing with the Trump administration, but potentially also for the economy, because what we're seeing even over past numbers that have been crunched, and there's a Wall Street Journal piece today talking about the impact of tariffs on aluminium and steel, and saying effectively the cost was borne by the US consumer. The American Economic Review said it cost consumers about $1.5 billion annually, and previous tariffs have also had a longer lasting effect than one would expect, even if they are revoked. Are we truly talking about some sort of economic contraction? Are we talking about stagflation? Which of the words are really appropriate here, recession or stagflation?
Well, in the short term, you've got potential huge risk, and it's a very difficult problem for the Fed to deal with. Kind of stuck between a rock and a hard place between, trying to create price stability, as well as keep the economy, in good shape. It's going to be a tough job in the short term, but we do know that recession tends to force pricing down eventually. So, short-term pain. And I've seen a lot of research talk about this sort of short-term pain to get some sort of longer-term benefits. So you could see weak growth, slightly higher inflation in the short term, but eventually that weak growth will draw inflation down.
Bryn, good morning. I would like to get your thoughts on European bonds in a more specific. Thinking about what happened last week in terms of moves in the bond market, and the narrative around more defense spending. What I would like to understand is, where do we go from here?
Well, look, Germany's had this debt break on. If you look at some of is it 60% of GDP? They've got a huge amount of capability to release some capital into the European economy, desperately needed. And that would possibly, the question is, does defense spending lead to a transmission mechanism for the economy? Probably not. Does infrastructure? Definitely. Can they repurpose factories, which they will need to do? I mean, some of the factory data coming out of Germany is pretty weak. But look, it's not a done deal. If you actually look at the Bundesrat, they need 69 votes to get this through. And, at the moment, if you look at the composition, there's 46 votes required from the 69 votes. And it pretty much comes down to Bavaria, I think. If Bavaria decide to vote against it, they've got the Conservative Party as the most relevant party there. So it could just come down to the one region that's required. Now, if that's the case and they don't vote for it, then bund yields are going to come back down quite some margin. But that's an outside bet. Ultimately, I do think that Germany and Europe will need to spend on infrastructure and growth. And if they do, yields will continue to be pushed a little bit higher, I think. And again, it becomes a very difficult job then for the ECB.
I would like to understand also the correlation here, perhaps, with what we witnessed in terms of UK gilt yields move also last week. Because if we are following the conversations around defense spending, the UK had already said they were going to spend 2.5% of their GDP in this. So explain to us why gilt yields moved higher as well, and where do we go from here, particularly as we approach the budget as well?
Yeah, so it's rare that gilts don't perform in tandem with the US or bunds. You do get some discrepancies from time to time, but overall, the three major economies, Germany, US, and UK, do tend to move in line somewhat. Of course, last week we saw US Treasury yields, perform much better than gilts than bunds. But let's face it, the UK's fiscal position is quite tenuous. We've already seen a couple of attacks on the UK gilt market in January this year, and of course going back to the trust budget. And with CTAs, I think there was about 80% of all derivatives outstanding were in 5 hedge funds. And the structure of the gilt market at the moment means that you can borrow to short the gilt market, which is not healthy. So when you get moves like this, it's quite easy to have a little move on the gilt market. But yes, the UK fiscal position is going to weaken. Let's face it, they're putting up national living wage, national insurance contributions. If you want any anecdotal evidence, you ask second-year students at university whether they can get a placement next year. No, most of them can't. So the UK labour market is going to tighten quite aggressively into the summer, and that worries me about UK growth. So again, the Bank of England's got a difficult problem of dealing with extra supply into an environment where the economy is slowing. So I do think this is going to be tough for all the central banks, where you're going to get supply, you're going to continue to get inflation pressures, but you're going to start to see growth start to weaken. So yes, a tough job for a central banker this year.
Bryn, help us out with the trade, because what we saw from some of the fund flow data in the last week or so is that cash and gold are the areas that investors are heading to for safety. It's not US Treasuries. What do you see in terms of a trade on the fixed income space, whether it's around European assets too?
Yeah, look, we've been, it's very difficult to forecast duration right now. I tended to always make a call about being long duration or short duration. And I've done quite well through my career being able to do that and being able to trade technical ranges as well. I just think with the amount of information, it's like information overload. We've seen a decade of data a decade of information in a week is stuff I've been hearing. And as a result of that, it's very difficult. You're playing whack-a-mole all the time. There's a mole that pops up, you try and hit it, and it goes back down, and there's another one that comes up somewhere else. And so as a result of that, we've been remaining fairly neutral duration. You get quite big shifts in short periods of time. You can get whipsaw quite aggressively. On the credit side, I still quite like investment grade credit, but we're up at the higher quality end, continuing to like big cash generative businesses that have got low capex requirements and low leverage, because if we move into an environment of a weakening economy, you don't want to be in your highly geared businesses. So that's where we're positioned. It's quite defensive for me as a credit manager, but that's where we're at the moment.
I was about to say, play it safe seemed to be the message coming through. Bryn, thank you very much for joining us. Bryn Jones, Head of Fixed Income Research at Rathbones.
And in other news this morning, Chinese consumer prices fell more than expected in February. The consumer price index fell 0.7% year on year, the first decline in more than a year. Core CPI also sank for the first time since January 2021. Meanwhile, producer prices extended their decline down for the 29th straight month.
Coming up on the show, Mark Carney returns. The former BOE and Bank of Canada governor will succeed Justin Trudeau as Canada's next Prime Minister. Plus, the White House holds its first crypto summit. I'll bring you the highlights later this hour. And don't miss our conversation with the Implement AI co-founder, Piers Linney. That is coming up at 7:30 GMT. Mark Carney will become Canada's new Prime Minister after being elected leader of the ruling Liberal Party. The former governor of the Bank of Canada and Bank of England beat three rivals, including former Finance Minister Chrystia Freeland in a landslide win. Carney is set to take office in coming days and is expected to call fresh elections within weeks. Carney will take charge with Canada in the midst of a trade war with the United States. In his victory speech, he described Trump's tariffs as an attack on Canada's people and vowed to fight back.
There's someone who's trying to weaken our economy. Yeah. Donald Trump. And Donald Trump, as we know, has put, as the Prime Minister just said, unjustified tariffs on what we build, on what we sell, on how we make a living. He's attacking Canadian families, workers and businesses, and we cannot let him succeed. And we won't. The Canadian government has rightly retaliated and is rightly retaliating with our own tariffs that will have maximum impact in the United States and minimum impact here in Canada. And my government will keep our tariffs on until the Americans show us respect.
As tensions between Canada and the US intensify, NBC's News' Jay Gray takes a closer look at the goods facing tariffs on either side, as well as some of the other challenges facing Canada's next Prime Minister.
From Ottawa, where tonight economist Mark Carney has been selected as the new leader of Canada's Liberal Party. He takes the place of Prime Minister Justin Trudeau, who has said he is stepping down just ahead of what's expected to be a very close, very contentious race for that spot. And of course, this all unfolding as the back and forth over tariffs, as well as the trade war between the U.S. and Canada, is really intensifying now. Canadians protesting outside the U.S. Embassy, using their purchasing power to support homemade goods and products, pulling American liquor and wine from shelves, and sending a clear message to the world about the tariffs and President Trump's suggestion that their country could be absorbed as America's 51st state.
And this felt like a way that we could participate and just kind of say, we're going to stand up for Canada. We like being a sovereign nation, and so Canada's not for sale.
Just 2 days after signing an executive order initiating 25% tariffs on imports from Canada and Mexico, he announced he would postpone the move on a majority of the goods for a month, but says he is moving forward with the tariffs on Canadian steel and aluminum set to take effect in 3 days, and has said he's also considering other tariffs, including a 250% tariff on Canadian milk and dairy goods. Jay Gray, NBC News, Ottawa.
Meanwhile, in Germany, the leaders of the Christian Democrats and Social Democrats will formally begin coalition talks after the parties agreed on a range of common policies over the weekend. On the menu for the economy, lower energy prices and tax relief, providing a boost for several key industries. At a weekend press conference, the party leaders outlined the agreements reached so far and stressed the importance of alignment on key issues facing Germany.
Wir wollen ein Industriestandort bleiben.
We want to remain an industrial location. For example, we will reduce energy costs. A first step will be to reduce them by around 5 cents per kilowatt hour. We will create sensible investment incentives. We will have to discuss the details in the coalition talks, and we will start with a corporate tax reform.
If, shortly after the Bundestag elections, the CDU, CSU and SPD manage to agree on such fundamental, important issues of German, national, European and international politics, if we manage to build bridges together despite very different principles, points of view, opinions and also different characters, then this can also succeed elsewhere in the country.
And Annette is joining us with more. Good morning, Annette. What I would like to understand here really is what's likely to happen. We know that they are starting coalition talks, but is the plausible scenario here to actually assume that this is going to be the formation of the next government?
Well, probably yes. I mean, I think we need to look at two different matters. A, the formation of the government, and B, the pass-through of the change of constitution through parliament. So for when we talk about coalition building, it seems that the SPD and the CDU really want to get together because that's the only possibility for Germany to form a coalition between the CDU and the SPD for the next government. So I guess they are ready to compromise, and that's what we already see in that paper, which they put on the table over the weekend. The other question is whether they get the huge spending bills through Parliament, and that is probably more crucial for markets and also for the economic outlook, and that is more of a risky take because clearly what they need is a 2/3 majority of the old Parliament, the 20th Bundestag, so to say, and that would mean that they need all the voices of the Green Party. So they would need more than 70% of the lawmakers in Parliament voting in favor of those bills. And as it stands now, critics are quite loud because what they are saying is that currently it's all about consumption. It's not really fixed that the money will flow into investments. And I think it needs a firm recalibration, and that's what Friedrich Merz has already promised yesterday evening when he stepped out on public TV, that of course they will narrow it down and there will be more rules for that the money which then they will raise through these special purpose vehicles is dedicated to investments and not just consumption. As it stands now, as you were pointing out, the first priority is tax cuts for corporates, but then at the same time, it's also an increase of the minimum wage. Of course, that's a compromise to the SPD. And we could go through every single point here, and it's always something pro-business, and then there's a compromise, more social spending. And that is literally, of course, the result of having a two-party coalition, the Social Democrats, who of course wants to have a buffer on the social security net, and then the CDU, who wants to be more business friendly. So in a nutshell, I think what they need to see is a recalibration, and that's going to happen on Thursday.
Netta, thank you very much for bringing us the latest there. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.